In this video, I'm going to be sharing with you what I believe are the best ways to pay yourself as a director of a limited company in 2022-2023. Now, I try to make this video every year and often there's only one salary I recommend. However, there have been a number of announcements over the past 12 months or so. So things aren't as simple this year. I've actually got 3 different salaries to give you guys. So make sure you stick around for all of those so I can explain to you why I'm recommending different salaries for different groups of people. Before I get into the video, I just want to say I am not an accountant. This is not financial advice. I would highly recommend you speak to an accountant before deciding what salary to pay yourself. Also, this video takes quite a lot of time to put together, so I'd really appreciate it if you scroll down and hit that like button. And if you're not subscribed, subscribe to the channel as well. So up first, let's just run through these announcements so you guys can understand why things have been a bit more complicated this year. So initially they announced that the personal allowance is frozen for the next 4 years and will be staying at £12,570. That is the point at which you'll start paying income tax. They also announced the national insurance primary threshold, which is the point that employees start paying national insurance, is increasing to match the personal allowance as of the 6th of July 2022, which is really good news for us. However, because it's being introduced mid-year, so the tax year runs from April 6th, and this is being introduced on the 6th of July, so 3 months later. This is why things are a bit more complicated this year, but I'll explain later in the figures and how we can deal with that. The health and social care levy is also being introduced at 1.25%. Initially, this is going to be applied as an increase on the national insurance tax rate, but from next year, so from April 2023, it will be split out into its own separate tax and the national insurance rates should come back down to the level we saw last year. Dividend tax has also been increased by an additional 1.25%. As the HMRC know, us directors will do anything we can to avoid paying national insurance. So by taxing the dividends, they're going to catch us either way. And finally, the employment allowance has increased from 4 to 5,000, which is important if you use that method. And I'll cover that when I get to the salary at the end of the video. Now, before I dive into the salaries, I just want to talk you through some of the key elements that will help you guys understand how I got to the figures I'm going to show you later in this video. So up first is corporation tax. The current rate for 2022-2023 is 19%, and it is payable against net profits made by a limited company. Now, this is important as allowable business expenses can be offset against profits to reduce your corporation tax liability. That is why it's so important to get your salary right. It's because if you pay yourself a salary, you're saving 19% corporation tax on that business expense. So that's why a basic salary always makes up part of the most efficient way to pay yourself as a director of a limited company. Now, your salary will of course be subject to income tax because that is paid on your income and salary excluding any dividends. But the personal allowance for 2022-2023, as I mentioned earlier, is £12,570, and we have no intention of paying you more than that. So you should never really be paying income tax on your director's salary. The income tax rates, for those of you who want to know, the base rate is 20%, and that is from 12,570 to just over £50,000. Then from pretty much 50 to 150 is 40%, and anything over £150,000 is 45%. We then have national insurance, and there are a lot of national insurance figures on this page. So I'm going to go through this page a little bit slower as there's a lot to understand as it really impacts the figures that I give you later in this video. So the first thing is the national insurance LEL, or the lower earnings limit. And I like to call this the benefits threshold, as this is the minimum amount of money you need to pay yourself per month to qualify for state benefits, such as your state pension, which is the key one that most people are concerned with. And you can see that you only need to pay yourself £533 per month to get yourself above this LEL threshold. We then have the national insurance primary threshold, and I like to call this the personal or employees NI threshold, as this is the point at which employees start paying national insurance on their earnings. Now, as I mentioned earlier, in the past, the national insurance threshold has always been much lower than the income tax threshold, but from July that is changing, and we can see here for the first 3 months of the new tax year, these are your levels, so you can earn up to £823 per month. But from the 6th of July, that goes up to £1,048. So certainly something to be aware of, as these changing figures do impact the final figures. We then have the secondary threshold, And this is the point that businesses or employers start paying national insurance as well. So with national insurance, there's quite often double taxation. The employer pays national insurance and the employee also pays national insurance. They just kick in at different levels and they're also taxed at different rates as well. So you can see here the employee's NI is 13.25% up to 50,270, and anything over that is 3.25%, but employer's NI is 15.05% above the secondary threshold with no reduction over 50,270. So that's what I'm talking about, the double taxation from national insurance. And you've got the combined employees and employers NI taxation of 28.3%. That would be from the primary threshold up to 50,270. And then the final thing to look at before we dive into the figures is dividends, as there are always lots of questions around dividends. So I just want to cover these very briefly now. Dividends are only payable to shareholders from profits or retained profits from previous years. Now, some people will be questioning what happens if you're just starting a new business, you want to pay yourself dividends. What happens if you do that, but then don't make enough money? Generally speaking, what the accountant will probably do is take that money that you've paid yourself and they'll put it in the accounts as a director's loan to the business. So in effect, you will owe that money back to the business as a director's loan. But hopefully that won't be the case and you'll just pay yourself dividends and all will be fine and you'll make enough profit to cover those. Dividends are not subject to national insurance or income tax either, because they've got their own separate dividend tax. They can be paid throughout the year as either interim dividends, so I pay myself monthly, or after the annual accounts, and then they're called final dividends. Tax is paid via self-assessment, so you can pay yourself all year with dividends, but you won't actually pay the tax until you do your self-assessment, and you'll have to pay that tax by the following tax deadline. Now, the tax-free dividend allowance is £2,000, so you can pay yourself up to £2,000 of dividends each year, completely tax-free. But you can also add on any of the remainder of unused personal allowance. So you know that you can earn £12,570 tax-free as your personal tax allowance, but if you don't put a basic salary up to that limit, that gives you an unused allowance. So an example here we've got, there's your personal allowance. Let's say you pay yourself a salary of £8,000. That gives you an additional allowance of £4,570 that you can draw down as tax-free dividends. So potentially, there you've got the additional £2,000, you've got £6,570 of tax-free dividends because you used up your unused personal income tax allowance. And these are the new dividend tax rates for 2022-2023. The basic rate kicks in at 14,571, so that's your personal allowance plus the tax-free allowance there, and that is 8.75%. And then the higher rate and additional rates, which are the same brackets as income tax, have higher tax rates of 33.75% and 39.35%. So those are all of the key elements I wanted you guys to look at before we dive into the figures. If you haven't hit the like button yet, that'd be very much appreciated. And of course, subscribe if you want to see this video every year. So I've got 3 salaries to go through. Up first, we've got the simple sole director salary for 2022-2023. This maybe isn't the most tax efficient, but it certainly is the easiest one to do this year. And this is possibly the one that I'm going to be doing as well. So in 2022-2023, you can earn £14,570 tax-free. That is made up of your personal allowance and your dividend allowance. However, do not pay yourself £12,570 as your basic salary due to the double national insurance tax liability that I just talked about. Instead, you want to pay yourself a salary that is just under the national insurance secondary threshold and pay the rest as dividends. So what does that look like? That's what we're going to run through now. So this is an example based on earning £40,000 per year for a sole director with no other employment. So my recommended salary is £9,096 per year, which is £758 per month. That is just under the 9,100 secondary threshold, but above the LEL threshold to qualify for benefits, i.e. your state pension. So that way you can pay yourself up to £9,100. You don't pay any income tax and you don't pay any national insurance either. And that applies to both the employer and the employee. So that's why this is really straightforward, because there's no NI you have to account for or anything like that. And you also still qualify for your state pension as well. So dividends from £9,096, which is a salary I recommend, up to £14,570. They are tax-free as you're using your full income allowance plus your dividend allowance as well. Then anything from £14,570 to £40,000 is taxed at the initial dividend tax rate of 8.75%. So your total tax bill on that is £2,225. Remember, of course, that for all of these dividends, you would have already paid a 19% corporation tax on that money. So that is what I believe is the simplest director salary to pay yourself this year. If you're looking for the most tax efficient salary, you may want to consider this option instead. So as I mentioned earlier on in the video, the NI primary threshold, which is the employee's threshold, that increases to 12,570 from the 6th of July 2022. So it's going to parity with the personal allowance. So that gives you an additional option with this director salary. This provides an average NI primary threshold of 11,908 for the year. So it's increased from 9,880 to 12,570. Because this happens 3 months through the year, the actual average for the year is £11,908, which is £922 per month. However, the national insurance employers, so the secondary threshold, is not increasing. So the point at which the business starts paying NI, that is not increasing. It's only increasing for the employees. However, it's still more tax efficient to pay this higher salary, as the 15% employer's NI is worth paying to save the 19% on the corporation tax. I think I did the maths earlier, and that 4% difference will save you around about £170 for the year. So it's down to you whether the additional paperwork and legwork is worth it to save that money. So based on that, my recommended salary, the most optimal salary for 2022-2023 for a sole director of a limited company, is to pay yourself £922 per month, or £11,908 per year. Now, for those of you that are using payroll software, you may find that if you do 922 initially, they might try and get you to pay national insurance in the first 3 months. So keep that in mind. Some accountants recommend paying yourself a lower amount for the first 3 months, and then paying yourself a higher amount for the remaining 9 months. But it's certainly something to be aware of if you start seeing some funny figures popping up in your payroll software. But speak to your accountant. I'm sure they've got a plan to cover that. And just finally, national insurance payments will need to be made to the HMRC, usually on a monthly basis. So for some people, all of the additional legwork and making these payments isn't worth it for saving a couple £100 per year. And then finally, we have the employment allowance director salary for 2022-2023. So this allows eligible employees to reduce their national insurance liability, as there is an allowance you can claim back to offset against your employer's national insurance. So it's not available to sole director limited companies. There needs to be at least 2 people in the business. That can either be 2 directors, or it can be 1 director with at least 1 employee, providing both are earning above the NI secondary threshold. So this can also include husband and wife directors. So I know there are a lot of people out there that have this set up, and you can claim the employment allowance if you are set up that way. So the current allowance for 2022-2023 is £5,000. So that should give you plenty to work with to claim back that employer's national insurance. If the employment allowance is available to you, then pay yourself £12,570. So you're maxing out your basic salary, you're maxing out your personal allowance, you're taking full use of the employment allowance as well. Now, the employee's NI will be fully covered by the employment allowances. There's plenty of budget there to claim it all back. And there will be a tiny amount of employees' NI due on the difference between the average primary threshold for the year, which was 11,908, versus the actual salary you're going to be paying yourself, which is 12,570. There'll be a very small amount of NI you'll have to pay on that. So hopefully you guys have found that helpful, seeing the 3 different salaries you could potentially pay yourself. If you did, I'd really appreciate it. You hit that like button. If you want to see next year's video, make sure you subscribe to the channel. And what I'm going to do now is pop up a couple of videos. One will talk you through dividends in a lot more detail, and the other one will talk about the 60% tax trap, and I recommend you guys give that a watch.